So you're getting close to retirement and you want to know, is the 60-40 balanced portfolio safe for your retirement? Is it a good idea? That is what we're going to explore in today's video. For our analysis, we're going to look at the 60-40 portfolio risk, what have been the worst case losses in the last few decades, and what could we expect going forward? What would be a worst case in a recession? Then we're going to look at returns. What have the historical returns been for the 60-40 portfolio, and what type of returns can we expect going forward? Then we're going to take a look at what happens, or has happened rather, in the past if you had used a spending strategy like the 4% rule adjusted for inflation on a 60-40 portfolio. And finally, we're going to look at the current taxable cash flow, the dividend yield that you currently get on a 60-40 portfolio. To keep things simple, we're going to use SPY, the proxy for the S&P 500, as the 60% equity of our portfolio, and we're going to use AGG, the aggregate bond market proxy, iShares AGG ETF, for our 40% bond exposure. And for the illustrations that I'm going to show you, we are going to rebalance that 60-40 portfolio of SPY AGG on an annual basis. I like using SPY AGG ETFs for this type of illustration for three reasons. One, they're very cheap. 7 basis points for a 60-40 weighted portfolio in SPY AGG. 2, they're very liquid. There's a lot of money in these two ETFs. And 3, there's a lot of trading history. These two ETFs have been around for a long time, so we have access to a long period of data. We'll start with risk, so you can see how the 60-40 SPY AGG annually rebalanced portfolio performed in a bad market. This is 2008. We're looking at 12/31/07 to 12/31/08. And the 60-40 SPY AGG portfolio was down 18.92% for the year. We're looking at total return for this illustration. If an investor had $1 million in the 60-40 SPY AGG portfolio at the beginning of 2008, by the end of the year, they were down to $810,000 on a total return basis. In 2022, the 60-40 SPY AGG portfolio was down 16.11% for the year. If you had $1 million in this portfolio, you finished 2022 with $838,000 on a total return basis. So the first thing you need to ask yourself, if you are getting ready to retire and you're considering the 60-40 portfolio, is, can you handle an 18% or a 16% unexpected loss in any one given year? If we unexpectedly entered a recession and your portfolio were to drop by 15%, 17, 18%, would you be okay with that? If the answer is no, then the 60-40 asset allocation is too aggressive for you and you need to use a more conservative allocation. I cannot stress the importance of getting your asset allocation right the first time enough. I've been a financial advisor for over 25 years. I've met with over 300 wealthy families throughout my career. I've done a lot of financial planning, and it amazes me how many times I've met people who say that they're a 6 on a 1 to 10 scale, for example, which would equate to a 60-40. And then the volatility comes and they want to get out of the market. Or I meet them after the fact and find out that they sold out in the bottom of 2008. Met a lot of people that did that. So the problem arises because a lot of financial planners just don't spend enough time making sure that you understand what a 60-40 portfolio can really lose in a recession. You have to be comfortable for the potential for losses in the 60-40 portfolio. If you are not, you run the risk of panic selling. All financial planning software, any financial planning that you do, is going to assume that you stay invested for your entire retirement. The moment you start getting in and getting out of the market and making big changes to your investment portfolio, you are violating the financial plan and you can throw your plan in the trash. there's a good chance you can completely derail your retirement if you decide to market time. That is an important thing that you need to understand. When you do financial planning and you select an asset allocation, all of the planning softwares assume that you stay invested for the entire retirement period. Here is the 3-year risk to reward scatter plot for the 60/40 SPY AGG annually rebalanced portfolio. The last 3 years have been 4.54% annualized return and 11.34% standard deviation for the 60/40 SPY AGG portfolio. As the standard deviation goes from left to right and increases, you would expect more of this, more volatility. The returns also are moving up. Here's SPY on its own. Here's the portfolio. Here's AGG on its own. We're going to quickly look at the 5-year and 10-year numbers, and then we're going to use this data to help us assess what type of returns and risk we can expect going forward. Over the last 5 years, the 60/40 SPY AGG portfolio had 8.71% annualized total return and 12.55% standard deviation. Over the last 10 years, the 60/40 portfolio had an 8.47% annualized total return and a 10.17% standard deviation. Now let's use this data to help us make some assumptions about the future. We're looking at the 3-year, 5-year, and 10-year standard deviations and returns for SPY AGG 60/40 annually rebalanced portfolio. I have created a future expected return and standard deviation column. I guessed on the 6% here for future returns. I don't think we're going to have returns like 12.55 or 10.17 over the next 10 years. Too high. I also think we're going to do better than the last 3 years. So I'm saying let's use 6% as an expected return over the next 7 to 10 years for the 60/40 SPY AGG annually rebalanced portfolio. And then let's move up the volatility. Let's move it to 12. And that would mean that we're probably going to see some recessions over the next 7 to 10 years, or at least one. We expect some volatility. Where does this get us? If we go 2 standard deviations up on the 12% standard deviation for the future, my estimate of standard deviation, then that would mean 24% increase 2 standard deviations up. If we have a 6% expected return, our best case scenario would be a 30% 1-year upside. On the other side of that, if we went 2 standard deviations down, our worst case would be a minus 18%, consistent with what we saw in 2008. So what I'm telling you here is that I think we're going to see a 6%, maybe 7% type return on the 60/40 over the next 7 to 10 years. That would be my base case assumption. Again, lower returns than the last 10 years. And I've increased the standard deviation a little bit here. So my assumption is that we're going to have more volatility, a little bit lower return, but we're still looking at a historical worst case, minus 18%, consistent with 2008. And what I would also tell you is that by going 2 standard deviations up and 2 standard deviations down, we're looking at probably 95% of the return scenarios are going to be between these 2 numbers. This is the kind of math that you need to be able to do to build a financial plan, to understand your asset allocation. It's not enough to just rely on software. Too many financial planners do. You need to be able to calculate this stuff longhand, in my opinion. If your financial planner can't do it, find a new financial planner. Let's say you had retired 21 years ago on January 1, 2004, and you wanted to use the 4% rule as your retirement spending strategy with the 60/40 SPY AGG annually rebalanced portfolio, and you had $1 million in your retirement account. This is what your distribution pattern would look like if we adjusted for 3% inflation every year. In the first year, 2004, you would take out $40,000, and then $41,200, and then $42,436, so on and so forth. By January of 2025, your distribution will be $74,411. Now let's see how the portfolio held up throughout this 21-year period while you were taking these distributions off the annually rebalanced SPY AGG 60/40 portfolio. Here's your $1 million illustration starting on January 1, 2004. The purple line is the 4% rule in action. That is the 60/40 annually rebalanced SPY AGG portfolio with 4% distributed, the distribution sequence we just looked at, grown for inflation. Your ending value is $1.79 million as of January 21, 2025. I wanted to show you what the portfolio did if no money was taken off of it and you reinvested the dividends and the interest payments from the bonds. If you put $1 million in the 60/40 SPY AGG annually rebalanced on 1/1/2004, by January 21, 2025, you'd have $4.86 million. Your total spending over the last 21 years was $1.22 million. And always remember, when you look at an illustration like this, if you use a stockbroker and you pay commissions or you have a financial planner who charges you advisory fees, your returns would have been less than what we're looking at here. The reason that I chose a start date of January 1, 2004 for this illustration is that the AGG ETF did not start trading until late 2003. So 2004 was the first year that we had trading data for both SPY and AGG. As of January 21, 2025, the trailing 12-month dividend yield on 60/40 SPY AGG annually rebalanced portfolio is 2.2%. If you had $1 million in your investment account and the dividend stayed the same, you could expect to receive $22,000 in cash flow off of a 60/40 SPY AGG portfolio. Now, right away, you should notice that that's not 4% like we saw in the previous illustration. So most people who are using a 60/40 balanced portfolio in retirement are going to spend more than the income produced on the portfolio. Important concept for you to think about. You're going to need to spend some of your principal, which could be in the form of capital gains, throughout your retirement if you're using the 60/40 portfolio and you plan to spend 3% or more of the portfolio. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.